Hey everyone, welcome back to Corporate Decoder. Today, EVO just filed their quarterly report, and the going concern warning sounds louder than ever. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is growing revenues, but the real question is if they can survive much longer without a massive cash infusion. We're looking at EVO Holdings Incorporated, and this is their quarterly report on Form 10Q for the period ending May 31, 2026. It gives us a snapshot of their financial health. This filing means they are reporting their performance quarterly, which is standard for publicly traded companies. The company's name itself tells us they are involved in the air conditioning business, specifically heating, ventilation, and air conditioning, or HVAC. As of the 10th of July 2026, they had over 27 million shares of common stock outstanding. The par value, which is a nominal amount, is very low at just 1/1000th of a dollar. Let's dive into the balance sheet. This tells us what the company owns and owes at a specific point in time. Looking at their assets at the end of May 2026, they had about $43.6 million in total assets. This is down from about $45.7 million in August 2025. Their current assets, which are things they can turn into cash within a year, decreased from about $527,000 to around $440,000 at the end of May 2026. Their cash balance has shrunk quite a bit, going from nearly $93,000 in August 2025 down to just over $35,000 by May 2026. That is a big drop in readily available cash. They have about $310,000 in inventory. This is a decent chunk of their current assets, but it is down slightly from over $316,000 previously. Now here is something interesting. They have these technology-related intangible assets that are valued at over $39 million. This is a huge number for a company with only 22 employees. This likely represents patents or licenses they acquired, but it is a significant portion of their total assets. On the other side, we see liabilities and shareholders' equity. Their current liabilities, the money they owe in the short term, have actually increased quite significantly from about $3.2 million to over $4.4 million. A big reason for this increase is money owed to shareholders, which climbed from about $2.4 million to over $3.5 million. This suggests shareholders are injecting cash, but it is still a debt the company owes. Total liabilities stand at about $4.4 million. Shareholders' equity, however, has decreased from about $42.4 million to about $39.2 million. This is largely due to accumulated deficits, which we'll talk about more. This accumulated deficit is a staggering $56.9 million. This number represents the total losses the company has incurred since its inception that haven't been offset by profits. It is a big red flag for financial health. Now let's look at the income statement, which shows their revenue and expenses over a period. We're looking at the 3 and 9 months ending May 31, 2026 compared to 2025. In the 3 months ending May 31, 2026, revenue was around $123,000. This is a big jump from just about $37,000 in the same period last year. That is over a 231% increase. For the 9 months ending May 31, 2026, revenue was about $211,000, up from about $160,000 in the prior year. That is a 32% increase. So the business is growing its sales. But here is the catch. The cost to generate that revenue, the cost of revenue, also shot up dramatically. For the 3-month period, it went from about $8,500 to nearly $117,000. This means their gross profit actually dropped significantly. It went from a profit of about $28,000 in 2025 to a profit of just about $6,800 in 2026 for that 3-month period. For the 9-month period, they went from a gross loss of about $8,300 to a slight profit of about $10,000. This shows that while they're selling more, their profit margin is being squeezed. Operating expenses also saw a big change. For the 3-month period, they decreased by about $150,000 to roughly $1.1 million. This is mainly due to lower general and administrative costs. Despite the revenue growth and lower operating expenses in the short term, the company is still losing money. For the 3 months ending May 31, 2026, they had an operating loss of about $1.1 million. For the 9 months, the operating loss was about $3.1 million. This is an improvement from the previous year's 9-month loss of over $7 million, but it is still a substantial loss. Ultimately, the net loss attributed to the company's shareholders for the 3 months was about $1 million. For the 9 months, it was almost $3 million. This statement tracks the changes in equity. It is where we really see the impact of those accumulated deficits. Starting at the end of August 2024, their total equity was about $51 million. They issued some stock for services, but that just barely boosted things. Then through net losses, their equity kept decreasing. By May 31, 2026, their total equity has fallen to about $39.2 million. That is a drop of over $12 million in less than 2 years, primarily driven by ongoing losses. The cash flow statement tells us where the company's cash is coming from and where it is going. For the 9 months ending May 31, 2026, they used about $980,000 in cash from their normal operations. This is up slightly from about $900,000 used in the same period in 2025. This indicates that despite growing revenues, their core business activities are still consuming cash. On the other hand, they generated about $1.1 million from financing activities. This mainly came from loans from shareholders. Even with that financing, their overall cash balance decreased by about $114,000 over the 9 months. This is after starting with over $93,000 and ending with just about $35,000. That is a pretty low cash balance for a company of this nature. Let's look at some of the notes which give us more detail. This first one explains how the company came to be. It details a series of transactions in late 2021 where EVOAir International Limited was acquired, and there was a significant change of control. The company's core business is in HVAC products and services across Asia, acquired through various subsidiaries. This is a crucial note under accounting rules. Companies must disclose if there is substantial doubt about their ability to continue operating for the next year, and EVOH Holdings Inc. is flagging this directly. They explicitly state they have not yet established enough revenue to cover costs. This goes back to that massive accumulated deficit we saw on the balance sheet, over $56 million. They've also had net losses in both the 3 and 9 month periods. Management's plan includes expanding product offerings, moving into new geographic markets, diversifying revenue streams, and improving profitability. They're also preparing to get listed on the Nasdaq capital market, hoping this will help them raise more money. However, the very next sentence says the financial statements are prepared assuming they will continue as a going concern. This is a standard disclaimer, but the fact they have to state it so prominently, right after detailing the going concern risk, is concerning. It is like saying, we hope to stay alive, but we are not sure how. This section details accounting methods. One important part is how they handle revenue. They recognize revenue when a customer gets control of their products or services, which is pretty standard accounting practice. They have significant intangible assets, mainly patents and trademarks, valued at over $39 million. These are being amortized over 20 years. This note gives more detail on those intangible assets. They valued Technology 1 portable air cooler at over $27 million and Technology 2 condensing unit at over $55 million. This makes up the bulk of their intangible assets. They are amortizing or expensing about $1.9 million of these intangibles in the 9 months of 2026. This is a non-cash expense, but it affects their reported losses. This note mentions a reverse stock split that happened. They did a 1-for-4 reverse stock split in September 2024. This is often done to boost a stock price and meet exchange listing requirements. It artificially reduces the number of shares outstanding, increasing the per share price without changing the company's total value. Historically, about half of micro cap companies that do reverse splits eventually get delisted. Think of companies like Sears or Radio Shack. They often went through splits as part of a struggle to stay alive. For EVOAir, this move might be a signal of their ongoing fight for survival. Even though they are losing money, they have operations in several countries like Singapore, Malaysia, Cambodia, BVI, and China, each with different tax rates. They have significant net operating loss carryforwards, which means they can use past losses to reduce future taxable income. Currently, this is about $57 million. However, they've also recorded a valuation allowance for that entire amount because it is uncertain if they will ever be able to use them given their current financial situation. This section is management's narrative about the company's situation. They start with a standard disclaimer about forward-looking statements, meaning they are talking about expectations and predictions, not guaranteed facts. They reiterate the company's background, the acquisition of EVOAir International, and the change of control in 2021. Here they talk about needing working capital and planning to raise more funds. They don't have lines of credit and rely on advances and issuing securities. They acknowledge that further stock issuances will dilute current shareholders. This is where they break down the numbers. As we saw in the income statement, revenue more than tripled in the first 3 months of 2026 compared to 2025. This growth is driven by sales of their EVOAir air conditioners. They're focusing on distribution, private labels, and licensing. But that revenue growth came at a cost. Cost of revenue exploded, leading to a lower gross profit. They attribute this to higher production and product costs due to increased sales. This is not ideal. Higher sales should ideally lead to better margins through economies of scale, not worse. Operating expenses did decrease, which is a positive sign of cost control. Despite that, they still have a significant operating loss. Management seems encouraged by the revenue, but the numbers show a company that is selling more but struggling to make a profit on it. Looking at the 9-month period, revenue is up 32%. Again, cost of revenue is also up, but gross profit improved from a loss to a small profit. The big story here is the dramatic reduction in operating expenses, down 56%. This is largely due to lower costs related to stock-based compensation and other administrative overhead. This significant cut in expenses led to a much lower operating loss for the 9-month period, a 56% improvement. This section deals with cash and how the company manages its money. Their working capital, which is current assets minus current liabilities, is negative and actually got worse. It is now a deficit of about $4 million, up from about $2.7 million. This means they owe more in the short term than they have in short-term assets. The cash flow from operations still shows a significant outflow, meaning the business operations are burning cash. The financing activities, mainly from shareholders, provided some cash, but overall, their cash pile is dwindling. This is where they discuss internal controls for financial reporting. Management admits that their disclosure controls and procedures were not effective as of late 2024. They identified several material weaknesses. This means there is a real risk that accounting errors could happen and not be caught. They admit to not having enough experienced accounting staff. They lack proper written policies and procedures, leading to a messy closing process for their financial statements. There is a lack of segregation of duties, and they don't have an audit committee or independent oversight. These are fundamental good governance practices they are missing. They are working on fixing these issues by hiring consultants, training staff, developing a procedure manual, and planning to form committees like an audit committee. But these are plans, and the weaknesses existed as of late 2024. They state they are not currently involved in any significant legal proceedings. This is a list of all the documents filed with the report. This confirms the filing for the reverse stock split we talked about earlier. These are certifications from the CEO and CFO confirming the accuracy of the financial reporting. Finally, we have the signatures of the CEO and CFO attesting to the truthfulness of the report. So what is the story here? EVOH Holdings is growing its revenue, which is great to see. They're selling more air conditioners. But that growth isn't translating into profit. In fact, their costs are rising faster than their revenue. Squeezing their margins, they are burning through cash. Their accumulated deficit is massive, and they're flagging a serious going concern risk, meaning they might not be able to stay in business for much longer. The lack of internal controls and the need for a reverse stock split are further signs of financial distress. While management has plans to turn things around and is seeking more funding, the current numbers paint a very challenging picture. It is a classic case of a small company struggling to scale and find profitability. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Check out the Discord in the description.